That is a doorknob.
What's going on, you guys? Welcome back to another video of The Common Investor. Today we're going to be doing another portfolio breakdown. We're going to be going through Chris's portfolio. It's pulled up here in a nice pie chart that he took probably 40 minutes to complete. So, Chris, I'll let you take it away.
Okay, so as you can see, my three biggest positions are in the three stocks that I'm most bullish about. This is in Bank of America, which obviously being the second largest bank, I'm pretty confident. I got in at a good price, so hopefully we just see gains from here. My second biggest position is in Raytheon Technologies, and if you've been watching the channel, obviously I've been really bullish about Raytheon. And second biggest aerospace and defense company now that they're Raytheon with United Technologies. They're looking a lot better balance sheet wise than Boeing right now. So hopefully it plays out. And then there's Luke with the Boeing. Then my third position is in something I didn't really understand when I first started looking at the company, but I mean, it's in asset management. It's one of the biggest in Canada. They have assets in renewable energy, infrastructure, property, as well as credit. I mean, they also have limited partnerships if you want to get into their specific sectors. You can invest specifically in the renewable sector, but I decided to go with the blanket top chain of all the subsidiaries, and that's the asset management, which will get exposure to every single sector that they have. Some of my other positions, the one that's had the biggest gain was Smile Direct Club, which I'm still very bullish on. Wish I put a little more money into them when they're down at $4, but they just got a patent for their business model, so non-compete for 18 years, I think it is. So, I mean, in their sector of healthcare, I guess you could call it, they're looking really good right now. Still got to keep that very, very long term. Hopefully it pans out. Some of my other positions are smaller. I don't know.
If it pans out a little bit more, you might be able to fill your gas tank. Another 100%, you're right there, buddy.
Oh, I mean, yeah, they're up like 75%. I kind of wish.
Yeah, and you put a box of crackers into them.
Oh, I put $100. I don't know. They're really long term, really, really long term. I want them to be up at $60.
Well, you're in the wrong company, bud.
I mean, they IPO'd at 20.
Have you looked at consumer trend, the trend of IPOs that are targeted towards consumers? Luke can tell you a lot about his favorite thing called Casper.
I can tell you about trends. But yeah, Casper, I mean, honestly, that was a quick trade of mine, and I should have held on because now we would have been up over 100%. I mean, some of these things are these smaller, super small caps, like Smile Direct Club, Casper, the ones that have IPO'd probably within the last year that are real small cap. I mean, they're good traders, good trade plays for sure. I feel like Smile Direct Club, you're over 100% on. Investment wise, it's definitely risky just because there's.
Yeah, that's
not when you put a box of Ritz crackers into them.
But crackers, God!
You bought a backpack for more than what you have in the Small Direct Club, and you thought they were going to be a $60 stock.
I think they have a potential 10, 15 years from now. I mean, they basically.
And why'd you only put a box of crackers into them?
I mean, if they come back down, I'm going to put more money into them.
Chris, let me ask you this: if you think they're going to 60, why aren't you deploying more cash into them right now?
Why am I not deploying more cash into them right now?
Because he won't put his money where his mouth is, Luke.
I like that. I like that.
I
mean, $60, and what are they at right now?
I mean, I don't want to put $1,000 into Smile Direct. That's too risky.
He has no basis for why he thinks it should be $60. It's just a random number he's throwing out of thin air.
All right. Going back to your two biggest positions, Bank of America, Raytheon Technologies. You mentioned they're number 2 in their industry. Why did you go for the second best instead of the best in the industry? Do you think they
I
have
mean, with
an
Bank of America, I mean, it just has a better buy-in price, honestly. JP Morgan Chase has a very high buy-in price. And honestly, Bank of America, I mean, they were up at like $33. And before this coronavirus. Um, but I just thought I could get them at $20 versus paying. I'd have to put more capital into JP Morgan, and I didn't want to do that.
Here's my thought. Yeah, it's obvious JP Morgan Chase is the best that there is. There's no denying it. I was eyeing Bank of America when they were 32, and I still like them at 32. I think as a mid cap value, Bank of America is probably one of the best there is. I'm out of them currently. I'm not in them currently, just because I don't like banks right now. For pretty obvious reasons, but I think Bank of America in itself is a great long term play. I don't think you're going to see much significant difference between growth in J.P. Morgan Chase and Bank of America over the next 5 years. I don't think them being second is something that you should really be concerned about. Versus, where you look at Raytheon Technologies, I would pick the number 2 in that sector over the number 1 in that sector in my sleep. We all know how much I hate that piece of trash Boeing.
And I got them right when they merged. So at like $51 a share. That company is probably worth over $100-something a share.
Well, you said Raytheon is a defense company, right?
Aerospace and defense.
What's Lockheed Martin? Are they not?
They're the same thing. They're a defense company.
Wouldn't Lockheed Martin be the number one?
But they're not in aeros. They're not.
They make missiles and stuff.
I don't think Lockheed Martin is. It goes Boeing and then Raytheon Technologies.
Okay. Still okay. I was thinking it was Lockheed for some reason.
I think Lockheed's more just defense.
Okay. Yeah.
I don't know. There's a couple big defense companies that have been seeing huge gains, but they all have, like I said, really high buy-in prices.
I think here's the thing with Raytheon is it's not just Raytheon anymore. It's Raytheon Technologies, which is a merger between United and Raytheon, which I believe makes it larger than Lockheed Martin.
Raytheon and United Technologies combined, and then they had to get rid of 2 of their spin-offs, and those are both S&P 500 companies now, Otis and Carrier.
Oh, baby, Carrier.
The United Technologies was very, very big, and when they combined with Raytheon, they made it even bigger.
Oh, we love Carrier.
Question for you. Going back to Bank of America, are you concerned that they haven't hit their all-time high since 2007?
No, I don't think a concern.
I'm just gonna go off that. I like Bank of America myself. I think they've been growing in the past 5 years.
I just think it's more of a safer. It's not going to see the growth that some of these companies. It's like it's a value stock essentially.
You don't need it to even hit the 2008. What was it in 2008? It was like what, 60? 60
bucks. Where over the same course, JP Morgan has more than 100% growth, where Bank of America has seen a negative growth.
Here's the thing about value stocks, though. When you look at a value stock, it's not a fast grower. It's a slow grower. So when you're investing in a value stock, you're waiting for the market to correct itself. You're waiting for the market, where you're waiting for the company kind of to catch up to the market. So it's not saying that Bank of America is a worse company than JP Morgan Chase.
Bank of America is a good long-term holding stock.
Yeah,
they're gonna keep creeping up.
And it being a value stock versus a growth stock, a gradual increase is
I'm not really looking for anything huge with Bank of America. Like,
It's a
Dude,
nice
even if
cornerstone.
it goes back
it's
up
a
to
nice to have in the portfolio just to keep myself like.
even if it goes back up to $35, you're still up 66% on it. I mean,
Yeah.
where's the complaint in that? Even there is none.
Yeah, I like
I'm
bank.
saying based on those numbers versus what JP Morgan and Chase can do within the next 5 years, I don't think there's a difference. I think being in Bank of America right now versus JP Morgan Chase, I don't think there's a significant difference between the two based on growth potential.
I mean that the one I mean Ally Financial, that's my other financial like sector company. They're up like 30%. It's insane.
Yeah, because everything financial shot. We're talking about list the date. What's the date? The 29th. So remember this day is the day where everything shot up.
Week is going to be a big week. I don't
Yeah.
think we see a dip back down till next week.
This is the day that Gilead was supposed to come out with remdesivir trial information, and a bunch of other stuff was coming out. So for people that are watching this late, this is the day that we're talking about.
Like,
so Ally shooting up like 15%
I
today.
have to say, I mean, Brookfield Asset Management and Bank of America, those two stocks I have the most in, and they didn't grow as much today. But again, they're more of a slow growth
Long-termers.
kind of. You're gonna get consistent growth.
Here's the thing with Bank of America, it didn't get pounded as much as the rest of these. I mean, Bank of America went from like $33 down to $20. It didn't drop below that $20. You saw Ally Financial drop from around $40 down all the way to like $10.
Yeah.
People,
So there's a lot more room to recover for those things that got hit a lot harder. Bank of America was never. I was watching Bank of America and it was never going to drop below 19. I was waiting for it and it was never going to happen.
people are always going to need banks.
Yeah, it's just the short-term outlook for Bank of America
I
wasn't
mean, that's
great,
why
so
most
that's
of
the
my
reason.
portfolio is based in financial and energy, and then I have a couple.
Yeah, honestly, everything in your portfolio is like stuff that people need, other than like Disney and Starbucks, which aren't.
Yeah,
that-
and those are
They're
definitely.
telling me people don't need Disney. Just the other day, Luke was telling me Disney Plus was a necessity for every household.
You're gonna see the numbers. They're they already announced the numbers.
Well,
It's
you're going to see the numbers when parks get closed for another 2 quarters.
Now when
And
I
it's
have
40% of their revenue.
now when I have remdesivir running through my veins.
We're not medical professionals.
Yeah, I mean the stocks that I really want to add to, I want to add to Starbucks. The thing is when I
really
got
good
into
company.
Starbucks, they were like one of the early shooters that just kind of went up. They went up $10 in the matter of like a day, like weeks
Do you,
ago.
do you know
Chris,
why?
how much of a discount did you get them on from like their high?
Starbucks?
Yeah, I'm just wondering.
I don't know what their high was. I got them at 64.
Well, I don't know.
Their low was like 50.
I don't
I
follow.
think their
Like,
high was like 80 something.
all right, yeah, Starbucks is solid. Like,
But the thing is like I bought like 3 shares of them, and then all of a sudden, like the next day, they went up $10, and they haven't left it.
Do you know why? Do you know why is the question?
Well, it's because they've had a lot. Well, I mean, China. They're opening up things in China.
But do you know why?
does it have to do with that luck
Luckin coffee, baby. Luckin coffee. The coffee that was going to be the Starbucks of China, that's been falsifying their data and how many people have been coming into their shops and how much their sales have been, falsifying their foot traffic. Once that came out and Starbucks said, "Hey, we're open in China."
Everyone just switched coffee stocks.
So once you saw Luckin go down, you could look at the numbers. Dunkin' and Starbucks both shot up. That would have been a day, because you're not going to get Starbucks back down at that number unless we're seeing a W-shaped recovery, which you're so. I mean, you're very bearish on this market right now, which I mean.
Yeah, so I mean, I'll be honest. I have 60% cash on the sidelines right now. Probably today, it probably wasn't that good because I mean we saw a gigantic jump today. It was insane.
But I mean, when you're investing rather than trading,
So
long-term.
about your 60% cash, like
63% cash.
63, whatever. When are you planning on deploying it, and like are you like gonna increase these
So
positions?
I'll go through what happened. So like I said, I'm a new investor. I really started getting interested when it was at the lowest point, and by that time I didn't know which companies to invest in, so I kind of missed out on the low. And then like a month later, I was like, here, I'm gonna start putting some money in, blah blah blah. I was like, I'll buy some couple shares here, there, see how it goes. Hopefully we have some down days. And then the market just kind of kept going up and then up and then up and then up. And I was like, I don't know how long this is going to last, but it doesn't seem like it's going to keep going up. I think I'm going to get some down days where I can buy some more shares. Unfortunately, today it kind of blew up, and I missed out on a lot of huge returns with having 60% on the in cash. But like I said, I'm very bearish in this market. So I have a feeling that we're going to see some sort of W recovery. We're probably not going to test the lows, but we're going to go down again. I don't think it's going to be as severe, but
What makes you think that we're going to be in a W recovery versus like you or like a swoosh?
The reason why it's a W is because historically, in every recession market, usually it's a W recovery. That's usually what happens.
You want to know why? You want to know why you think this is W recovery and not a V recovery or a check recovery? Because he got 63% of his cash on the side.
No, but that's always been that was my view before investing.
Because if he had all of his money in stocks right now, I'm telling you right now, it's a V. It's a V.
Yeah, that's how you're feeling right now. Obviously,
no, I'm not feeling that. I'm just thinking that the prices that you got that at, I think you waited way too long, and the prices that you got those at, I think the bottom of your W is going to be the same price that those are at, and you're not going to get a bigger discount, and you wasted.
Yeah, but I mean that's part of investing. I mean, I can't predict the.
Well, part of investing is actually putting your money into stuff.
What would you do? What's your scenario if it is a V-shaped recovery? Then what are you gonna do?
Stick with his 37% that's in and take out the 63% cash, because there's no point in chasing a market when there's no revenue for 2 months or 2 quarters.
Yeah, I honestly don't see. I see some sort of decline. I don't see this market continually rising in a V shape.
It's the what if though.
What if? I mean, I'm kind of screwed. I mean, like, I don't know
having
63%, I could put in cash now, and then the thing is, if I put in cash now, then all of a sudden, if we do get that W, it's like, well, now, I mean, I still got it at discount, but I didn't.
Yeah, but you're missing the entire point of a W. You know what happens with a W? Look, mark this point, right? It goes back up. So we might be here. If you're thinking about a W and you buy here and it goes back down, all you got to do is hold and it goes back up. That's the thing. You don't lose money until you sell.
Well, if it is W-shaped recovery, how far down before you start buying? Like
when it starts going back, when it starts consistently going.
Tomorrow we do a drop of like.
I mean, if it starts consistently going down, I'm going to try to buy as much as I can. I want to obviously add to every single position. But there's 2 other stocks that aren't in this pie chart that I'm watching at the moment, and that's Square, which is
overpriced.
Overpriced, yeah, it's definitely overpriced. I mean, I think people have been very bullish on it because it's been like the headline stock for financial in the coronavirus market for a lot of like YouTubers as well as financial websites and advice. But then the other stock is TJ Maxx, the TJX.
Why?
Dude, why?
Dude, TJ Maxx is like the fastest growing.
I mean, they have been consistently growing.
Dude, the return on equity last year was like 40%.
Honestly, now that you mention it, they kind of have something that online can't really replicate.
The thing is like when the retail market is declining and they're going up, there's a reason why they're going up because they're
not just TJ Maxx, they're Home Goods and they're Marshalls.
Well. I mean, you can't. The thing you find in their stores, you can't find online.
Yeah,
you really can't find it, and that's why people. Obviously, the retail sector market is getting.
Have you gone to TJ Maxx? Have you gone to TJ Maxx with your mom? How much stuff do you think she buys that she doesn't need? I've got an entire storage room.
Guy to ask this question because downward trends industries, I hate them. I don't touch them. They're just not my. I can't do it.
But I mean,
Is there a company right now that is like a discount retailer store?
The other big retailer
Walmart.
store that's a discount that might be a better buy than TJ Maxx is Ross.
Mm.
I don't like Ross. That's more like Midwest, isn't it?
No, I was saying online though. Like, is there like isn't like Alibaba
There's
something like that?
There's not. I mean, it only exists as like Amazon or
Amazon and Walmart, but
Yeah.
Walmart's not even close.
And I mean, if you want to buy in like the factory store outlets online.
Gotcha. So I think we have a business idea here. Let's start our own.
I mean,
Online.
there's definitely like Zappos and
Okay, if you want to buy stuff online for the same price as TJ Maxx, you know how you do that?
dropship.
You wait until they're having their 80% off seasonal sale, and you buy your Christmas stuff for next Christmas. That's the only way you're doing it.
yeah. I mean, they're TJ Maxx. I'm waiting for their financials to come out, and hopefully their stock drops, preferably under $45.
We're gonna get
And I
I
wanna
didn't buy any when it was under $45.
Because I hadn't bought anything.
That's my point. All right, what else can we talk about in your portfolio? Phillips and Oniok, pretty standard.
I think we can. I mean,
Oniok's natural gas. Phillips is oil refinery. That's all some cool stuff.
Disney's pretty standard.
Disney's pretty standard. Starbucks is becoming very standard. I mean, that's a pretty good growth company.
Are you looking at any other blue chips, Chris?
I'm not letting you talk.
I mean,
about
the only
Xerox.
other one is Microsoft. I mean,
I wouldn't chase Microsoft at this price.
but it's.
Yeah,
I mean,
it shot up quick.
a lot of those MAGAs are kind of
oh,
overpriced.
yes. The new term, the madness.
I mean, if you look at Amazon, it's like
That's
if
the
you
new
buy
that's the new
Amazon
term.
right now, I think you're doing something wrong, honestly.
Yeah.
No, if that's not true. Actually, with your mindset, Chris, you should be buying Amazon right now. Because
I don't know. I think
you think that the market is going to be bearish. You think the market is bearish. You think we're going to see another drop in the market because of COVID-19. If that is your actual belief, you should be putting money in Amazon. So you can't contradict yourself.
yeah, but Amazon or why? Because you're saying that if we see another dip in the market, Amazon's going to stay where it is.
It'll go up.
No, it'll go up. It's been opposite of the market. It's just like Teladoc. Like if we have a green day, Teladoc goes down. If we have a couple red days in a row, Teladoc shoots up. I mean, it's the stuff that benefits based off of COVID-19. So if you think it's going to be bearish, then Amazon would be something.
Well, the thing is
buy.
it's not COVID-19 that's what's it called?
But
That I'm
it is.
basing the
If there
bear
wasn't a
market off.
COVID-19, you wouldn't be
I'm
bearish.
not. It's not the virus itself. It's the financials that have resulted from the virus. That's
Well,
I'm
that's why we invest in companies that have good balance sheets and not Uber.
All right.
If it was, I mean, yeah. If
Let's
it was
wrap it up
virus-
there. Let's wrap it up.
If it was the virus and you had to stay home, I'd be like, hell yeah,
Wrap
buy
it up.
Amazon. But I mean,
Yeah, wrap it up, Chris. Wrap it up.
We're not talking about Uber. Wrap it up.
All right. Any last words, Chris, on your portfolio?
no, not really. I mean, it's a pretty standard. I mean, the only thing that people probably have never heard of is maybe not Brookfield, but I mean, there's a lot of Brookfield around the world that people have run into.
Yeah. Well, overall, solid portfolio. Hopefully, you get a W, shape recovery like you're hoping, and you take advantage of the time. But other than that, we'll kind of end it here. So, thanks for tuning in, and we'll see you in our next video.